And with me today is Peter Baker, a CPA based here in Washington, D.C., who has 25 years experience helping real estate clients do their taxes.
Well, there are really three things that I think are worth noting for this year. One of them is a new simplified method for home office deduction. The other is some changes in the standard mileage deduction for business use of your car. And the third is the Affordable Care Act's individual mandate, which goes into effect in 2014.
Well, let's start talking about this home office deduction simplification. What can you tell us about that?
Sure, Evan. The IRS has identified a new simplified method. And assuming for taxpayers who meet the criteria for deduction of a home office, and that criteria must be a primary location exclusively used on a regular basis for the business purpose, that individual now can avail himself of a new safe harbor, if you will, or a simplified method of deducting home office expenses. The IRS has identified in this simplified method a $5 per square foot for up to 300 square feet of office space, of business use office space, of course, which meets the criteria.
So up to $1,500.
So potentially $1,500 of deductible expense. In addition to this $5 standard deduction, the taxpayer also continues to deduct in full his itemized deductions, which are otherwise allowable, for his mortgage interest and for his real estate property taxes. And then finally, this method is electable on a year-by-year basis. So what I advise my clients is each year before filing their return, they should run both this new simplified method, the $5 a square foot, and compare that to the regular method. Now, the regular method had involved a cost allocation, again based on the square footage, of their actual cost to heat, telephone, utilities, as well as depreciation of that office space. So the answer is, the advice is, run the numbers both ways and deduct the higher of the two.
Peter, we hear from some of our members that sometimes they shy away from the home office deduction because they think it might increase their chances of being audited by the IRS.
Well, I hear the same things too, Evan. And in the past it has been a flag for a more likely examination. But if there were an examination to take place, it is a safe harbor. Those $5 per square foot would be allowed. And again, assuming that the taxpayer, the real estate agent, qualifies for this exclusive and regular use in business purpose of that space, I think it greatly simplifies the support and probably is less likely to be a flag for future examinations.
That's great. What's the second change you want to highlight?
The second change is another standard deduction, in this case one we're all familiar with, the standard mileage deduction. And the IRS, much like the safe harbor, has a standard mileage rate that they deduct, and most realtors are familiar with that. And in the year 2013, that rate was increased. And the 2012 rate was 55.5 cents, and it has been increased by a penny to 56.5 cents per business mile.
1 cent doesn't sound like very much.
Well, no, it doesn't, but for every 10,000 miles you drive, that's another $100 of deductible business expense. But it assumes, though, that you are substantiating, tracking, and logging in those business miles. And there are many methods available to realtors. They're already used to keeping a diary or a logbook for their appointments. They merely need to supplement that by writing down their business trips, purpose, and the approximate number of miles.
Now, we don't have to keep track with paper and pencil like the old days. Aren't there new electronic ways of doing this?
Well, there are. There are a number of apps that assist with tracking business miles. Many are for free and some are for a modest charge, but either way they have simplified or automated the drudgery or the tediousness of keeping track of business miles.
What about the third change?
The third change is not a part of the 2013 tax filing, but is a part of the 2014 year. There's an individual shared responsibility mandate or provision in the Affordable Care Act.
Oh, the Obamacare.
The Obamacare, that's right, that requires each taxpayer and dependents in their household to cover minimum essential health insurance. Well, minimum essential coverage would be using an employer's health plan that they've identified, using a state health insurance plan or the federal government's health insurance plans, and a number of other specified plans.
My understanding is you have to sign up by the end of March of this year in order to avoid some kind of penalty. Is that right?
Well, that's correct. The open enrollment period, which started in October, runs through March 31st.
Well, suppose I just let this go or let it slip and I don't get covered by March 31st. What's the worst thing that's going to happen to me?
Well,
How big is this penalty going to be?
This individual mandate does have a penalty, and there's really three things expected of a taxpayer. Either to have the coverage for each month of the year, meet one of the exceptions to the coverage, or pay the penalty. The penalty is the greater of $95 per taxpayer and dependent per year. It's capped at 3, and dependents younger than 18 years of age are at a half rate of the 95. The greater of that, or 1% of the household adjusted gross income.
Okay, so 300 at least, and maybe higher for a year.
And maybe higher.
Okay.
That's right.
Well, those are 3 great tips about what we need to know for taxes this year. Is there anything else you want to share with us?
Well, for all of my real estate clients, you are sole proprietors. You file a 1040 Schedule C. You all receive a Form 1099 representing your commissions earned during the year. So in terms of tax planning, the name of the game is identifying and substantiating business expenses, which you can apply against those commissions earned.
Mm-hmm.
So my biggest advice for those in the real estate industry is to track and substantiate their expenses as though they are a small business, which they are. Included in that, there are obligations to also pay quarterly estimated taxes. They're not getting a W-2. There's no withholdings taking place. And if they expect earnings, if they expect to have taxable income during the year, they need to pay quarterly estimated taxes.
And if they don't, there's a penalty for not doing
There's
so, correct?
both penalty and interest charges for underpayment of quarterly estimated taxes.
So you probably talk with your clients all the time about the necessity of these quarterly payments.
Actually, quarterly, I talk to clients where we will run the numbers that they've experienced for that quarter or that they expect for the entire year. And we will use that to generate their tax payment for each of the quarters of the year.